Welcome, everybody. This is Jeff Dobine. So thanks for joining. We'll allow everybody to log in here. Give us just a minute. Welcome, everybody. We'll get started and we'll have more joining. So grateful for you joining us. My name is Jeff Dobines. I'm the president of Southwestern Investment Group. So on behalf of our entire team of advisors and support folks, thanks for trusting us and for joining the webinar. I just saw the headline yesterday that's official that the pullback after COVID in March of 2020 was the shortest pullback of such severity in history. So who would have thought that we'd have a 38% pullback in the S&P and then the quickest rebound in the history of the United States economy, and a year and a half later be here with the markets at nearly all-time highs and the world opening up a little bit. So we've got a lot going on, and we're grateful to do these educational things. So we think that the more educated and knowledgeable we are, the more confident investors we can be, and that's been the key to our philosophy for 20 years now. So we're grateful for you. We one housekeeping item, if you could please, we've got a place at the bottom where you can submit Q&A. So if you will click on the Q&A button and submit your question afterwards, we're going to try to do our best to get to every question and provide a thoughtful answer. We've got a couple already that were emailed to us ahead of time. So I will monitor that, but just a quick reminder, we will probably have about a 25-30-minute presentation by Chris Jenkins, who's our special guest, and then we will ask Chris to help us get through the Q&A. So want to introduce Chris Jenkins. If you haven't met him yet, Chris is a dear friend of ours and has been for 20 years, but he also happens to be a local, lives in Franklin. His family and children all go to school here, but Chris is vice president of American Funds. And for those of you that know, American Funds is part of Capital Group, and Capital is one of the largest and oldest investment management firms in the world. So Chris has been in the business for 26 years. He's a certified investment management analyst, so that's a CIMA designation. He's also a certified private wealth advisor. And he's our direct contact for our team to get insight and perspective from the American Funds Capital Group's side. And they have boots on the ground all out the world. They're well known for their research and their intelligence and their thoughtful investment selection. So with the transition of the new administration, the new stimulus package, and the stock market at all-time high, we thought that this would be a great time to ask Chris to provide some perspective on what we should expect going forward. So again, we have Q&A at the bottom, and I would like to turn it over to Chris Jenkins. So Chris, thanks for joining us. Welcome, everybody. And Chris, thanks for your time and insight today.
Yeah, Jeff, as always, thank you. Give me the thumbs up. You can hear me, see me, everything. You know, we're getting good at this this technology stuff. I'd have never thought a year ago I would be stuck at home for for all this time. So I join you from the American Fund satellite office in downtown Franklin. So thank you, Jeff, as always, and Drew and Kelly and the whole team there, and all of our friends at Southwestern Investment Group. We think the world of the work you do and how well you serve clients, and thrilled with our not only professional relationship as an investment management firm, but personal relationship with many of you on this call and many of your clients. We've done a few of these over the years. So, hey, my agenda is pretty simple. I want to share some broad observations and where we see the world, maybe a little bit of catch up of where we've been, and maybe a little bit of look forward of where we see some opportunities. I think we would start by the picture on your screen right now is an important one, which is this lighthouse, and it's an apocryphal story that you may have heard before, but I think in times like this, it bears repeating, of the old U.S. naval captain who is in the dead of night, saw a light, what appeared to be a ship coming at him, and radioed ahead that he was the commander of one of the largest U.S. naval fleets and demanded that they move 25 degrees north or feel the great might of the U.S. Navy, to which the the caretaker of the spoiled the story here of the lighthouse responded. He said, "Hey, I'm a lighthouse. Your call here." And I think that's important as we consider this lighthouse in front of us, because as I've looked back, and Jeff and team, I know you have as well, as we've looked back over the last year, it's not so much that things are going to get in our way. It's often how we respond to them that will drive success. And I think that's an important consideration as we move forward from a market perspective. Again, we're going to be faced with some obstacles. And again, it's all about our response to these things, and not so much that we're going to go through them. So here's my agenda. Pretty simple. I have three big areas I want to kind of hit today. And again, plenty of time for Q&A. If I say something that spurs a thought, please type it in, and I think Drew or Jeff is going to monitor that. We'll certainly get to that from a Q&A perspective, but spend a little bit of time on the macro overview. Again, what we're calling this, getting ready for the world to boom, zoom, and consume. So we'll spend a few moments with a broad overview of what's happening from a macroeconomic perspective. We'll then spend just a few moments on an equity outlook. Where do we see opportunities? There's a lot of conversation in the marketplace now about how do we position equities in portfolios, and is it value, is it growth, is it innovation, is it dividends? So spend a few moments on where we're seeing from a global lens some opportunities there. And then finally, we'll wrap it up with a few broad observations on the fixed income markets, which continue to be a bit of a challenge for us to navigate as we move forward. So that's my agenda. Hit a couple of big key areas, and hopefully we'll wrap it up. Again, plenty of time for Q&A on the back end of this. So let's start with this kind of a little bit of a look back to last year, and maybe an economic view if we can. And again, no one ever predicts these pandemics, and I guess frankly none of us have ever been through one before. But clearly there is a hit on the global economy. You saw U.S. GDP, and it's a big number, and a 3.5% loss on a big number is a big deal. Europe, same story. Emerging markets, not a surprise to any of us. We felt the global hit last year as it relates to the response to the pandemic and shutting down of the economy. But I think it's important to note, and this is probably only going to raise other questions, but it's important to note that central banks on a global scale, and I'll say governments more broadly, the response to that in a fast and efficient manner allowed for the GDP growth that is projected, and candidly that we're experiencing today. Economic growth here in the U.S. and in Europe and in the emerging markets, truly on a global scale, has been remarkable. And you're seeing that even as the whole world has not yet emerged or reopened, you're starting to see clear signs of it. So the expectation of economic growth for this year is pretty good, but as we look forward to 2022, it's still pretty darn good. And I think that's an important acknowledgement, particularly as we talk about the stock market here in a moment and outlook from a market perspective. I think it's important to acknowledge in this conversation and long term as well, that stocks go up long term because earnings of companies improve. And broadly here, earnings of companies improve when you have a pretty robust economic environment. So we want to view the economic environment as a portion of the story, and why we think, as Jeff referenced, that the stock market is at an all-time high. A lot of that is economic growth on a global scale has been special. So again, it's boom heard around the world. As the world's reopening, you're absolutely seeing signs of that. And I'm going to show you a few examples here in a moment. So economic growth looks pretty darn good. But here's a risk in that. This question comes up a lot. Drew, I know you've emailed me a few times. Maybe some of you on this call are having some questions about this. And it's this idea that, okay, Chris, I hear you. Economic growth is good, but what about inflation? And depending on your personal situation or even your professional view, you may be seeing very real signs of inflation right now. And I want to give a little bit of context to that, because yes, there is higher inflation. Capital Group, our investment professionals broadly on a global scale here are in the camp that it is temporary. And you hear the term transitory inflation. We throw that word around like we knew what it meant 6 months ago. But now we all talk about transitory inflation. But I do want to give a little bit of historical perspective to this idea of what we're seeing from an inflation perspective. And there's sort of a story in three parts here. If you notice this purple magenta line coming across the middle, that's core inflation. So when you hear the Fed, and for most of us in our day-to-day lives, that's the impact of inflation on our lives. And the Federal Reserve has set a a benchmark, and their goal is to keep that around 2.5% or so. And we would propose that since they really got focused on that, 20-ish, a little longer years ago, they've done a pretty darn good job of keeping inflation in check. None of us have experienced inflation like we saw in the 1970s. The Fed has been laser focused on controlling inflation. So purple line, very consistent. Blue line that I filled in for you here, I'll give it some effect so you can see it here. So I'll make sure we're tracking the same thing. I'll fill it in for you here. That's raw material inflation. And when you hear a lot, and again, we feel it, again, depending on your personal and professional life, you may be feeling a lot of this. There is clearly inflation in the raw material space. Think steel, copper, lumber. And again, it's volatile, it's moving around. And we're seeing that, but we're of the belief that that is part of a supply chain disruption related to the closing of the economy on a global scale that we think we will work through over the next year, year and a half or so. Trust me, the inflation prints are going to go worse. The headlines are not going to get better overnight. I can assure you of that. But we really do think you're seeing clear evidence that that's going to work through. But what I think is important in this conversation, and again, this blue line, you can see the volatility in raw material inflation prices over the last 30 years or so, but kind of hidden in here in these gray lines, and I hope you can see it on your screen as well as I can, those are recessions. And I want to point out that in every recession since 1990, and again, certainly since the Fed got real active following 2000 of lowering rates, we saw a raw material inflation spike in every recession. Okay, I'll grant it in 1990, it took a couple of years, but the Fed approached that one a lot different than they have the most recent ones. But most recently, since really 2000, the Fed has responded rather quickly, and we've seen a dip in commodity prices and raw materials, and then a spike. We saw a dip, we saw a spike, we saw a dip, we saw a spike. So what we're going through right now from an industrial inflation is not uncommon. We've seen it before. Frankly, we've seen it in every other recession. But I think maybe there's a bit of recency bias going on with a lot of us that we're conflating that with CPI inflation. So again, I spend a little bit of time on that because if you're in the building business or you're trying to build something or you're trying to buy something, there's clear signs of inflation. We think that is going to work itself through. And maybe further evidence of that, and again, these are related topics clearly, is the interest rate environment. When we look at the economic growth globally that we've experienced over the last, certainly the last year or so, the Fed and central banks on a global scale's policy responses, as quick as they were, really bailed us out. So then the question becomes, well, where are rates going to go? And kind of makes sense out of the data that's on your chart here, but at every Federal Reserve, the FOMC, the Open Market Committee meetings, all of the Fed members of the FOMC, they vote, so to speak, of where do they think interest rates, the Fed funds rate will be by different timelines. And they call that their dot plot chart. You may have heard of it. So let me give you the summary of the dot plot chart right now. If you see in purple here on your screen, every FOMC member, I can tell you that, believes that rates will be at zero by the end of this year. The blue dot next to it is the bond market or the expected interest rate that the market thinks. So we agree. We say, hey, Fed, you're telling us rates are going to be at zero. Market agrees with them. Now, the median projection of the FOMC, not all members, but certainly the median projection is for rates to be zero at the end of December of 2022. So you get another year of zero rates. The market there is saying, well, not so fast. We think they're going to be a little bit higher. But as you fast forward to December of 2023, the FOMC's median projection is around the 50 basis point range. Market thinks it's going to be a little bit higher. So this is a little bit of the roadmap of what we think rates are going to be like. According to the Fed, we are in the Fed's camp on this as well. We think we agree with the conclusions they've reached and why they've reached them. So I would anticipate rates staying low for the next year, two, to be a little bit, forward looking. Now, I do want to give context because let's say that the bond market's right and rates move up by the end of 2023. Let me give you a little bit of historical perspective here, because the bond market say, hey, rates are going to be at zero. We think they're going to be 65 basis points or so. So still really low. And when I say really low, let me give you context. In 2019, that number was 2.4%. So again, well below where the Fed funds rate was leading in to the pandemic. And in 2008, the Fed funds rate was at 5.25. So again, if it's at zero or 50 basis points, we would propose that's still really low. The other thing, and again, we spend time on the macro stuff because it does factor into a lot of decisions that are being made from an investment lens. The other thing is the bottom half of the chart. I think this is important as well, because not only does the Fed control rates from their, the Fed funds rate and their ability to set policy decisions, but also, as we know, since March of last year, or I guess April of last year, when the Fed began buying securities, that they're going to have to wind that down at some point. They're still doing it today. Certain countries are backing off, and I think the ECB meets tomorrow, so it'll be interesting to see what they announce. But we would anticipate at some point, which and we'll say it today and the end of the year, that we believe the Federal Reserve will signal their intent to begin slowing down or stopping their asset purchases. So at some point, we know they're going to have to do it. They're going to signal that to us. They haven't signaled it yet. All they've signaled is that they will signal. So at some point, I would expect Jay Powell at the Fed to signal to us, to the market, hey, we're starting to slow this thing down and ultimately end asset purchases. Our belief is that will happen sometime probably in the next 6 to 8 months, maybe a little bit longer. That'll take a year or so to do. And at that point, when they're finished tapering is when they will begin signaling the hike. So keep an eye on the Fed. And you've heard this, one of the most famous mantras in investing is don't fight the Fed. And I think that's one of the reasons you're seeing the market continue to advance at such a rapid clip, is the Fed's intent to stay out of the way and keep rates low. Important discussion in that. So what has all that led to? Again, macro view, and then we'll start to look at some different equity opportunities. But the left-hand side of this chart is an important one, because what we've noticed over the last certainly year, but I could even propose building up for the last 10 years, is a significant increase in corporate cash. It's clearly at an all-time level. You've got over $3 trillion of corporate cash on the balance sheets, and then savings rates. You look at us, all of us on this call, most of us have saved a lot more money because we weren't spending it. We couldn't get the reservation at Culicino in downtown Franklin because they weren't open. So, but what we noticed, so savings rates have been big, and we think that that's about to, and I want you to think of it this way, macroeconomically at least, there's a spring that's being pushed down for the last year, and we're about to let our hand off of it. And we're already seeing clear signs of it. The right-hand side is a great example of that. If you look at Open Table, which is a dining reservation app some of you may use, I certainly do, we're back to pre-pandemic levels. So they're seeing their traffic back to a level that consistent with activity prior to the pandemic. So you could argue maybe dining's back. Airline volume is absolutely on the increase. We peaked down to, hovered in that down 70 to 80% range. And now we're back into the, probably only down 20, 25%. And I think that is going to trail up. I spent the last couple of weeks on a few flights, and I can report to you that the Dallas airport is quite crowded. Certainly the Nashville airport was, but Dallas and these big hubs, you can see people moving again. And that's this idea of boom, zoom, and consume, right? We see this economic activity, and we think that's going to be good for companies. So with the macro out of the way, again, economic activity looks good. Not terribly worried about inflation. Happy to go into that in Q&A. Not terribly concerned about rates on, certainly over the next year or two. And what does all that mean? We think the economic activity is going to be great. And what that's going to translate to is earnings for companies. So let's switch gears and take a look at the equity markets, and really identified 6 big themes that we're looking at and balancing as we're making investment decisions on behalf of investors every day. And I'll kind of walk through these pretty quick. But I think the first one that we have to consider is this idea of, and it comes up a lot, is as I'm thinking about positioning portfolios, that I recognize these FANG or Fangum stocks, your Facebooks and Alphabet, Netflix, Googles, all these companies have done well. But what about some of these value companies? And you can see on your screen here, I'll pick, let's do hotels as an example here, or resorts and cruise lines and whatnot. Not a surprise to you to say that Carnival and the cruise line industry really got rocked last year as those shut down. But you saw almost a symmetrical return of stock prices at least. And you can draw the line in the sand in that vaccine day, that November 6th to 9th, that weekend there where the announcements, we knew they were coming and they came. And since then, you can really draw a line in the sand, and you've seen wonderful investment results from the companies that didn't participate last year, right? We know these technology companies and more industries and companies that were suited to prosper in the pandemic did well at the expense of a lot of these energy and oil and more cyclical type of companies, but the rebound has been absolutely spectacular. So we would propose, because we're going to get into some of these growth stories here in a moment, that we're finding really compelling investment ideas right now on a global scale in a lot of these areas. And again, we were finding them last year, quite candidly, but those continue to be really good areas. So again, market discounted some of these old line industries prior to the vaccine. Once everything started to reopen, we absolutely saw that continuing, and we think that's an important message. Let's look at, so again, value stocks will make sense, but so will some of these growth stocks. We're big fans of a couple of trends. And I think one of us, or all of us, I guess, would probably argue that we saw significant penetration and acceleration of a lot of these digital things. The fact that we're doing this right now is a clear example. We're getting comfortable with digital delivery of different things. And we saw a significant increase, and again, highly investable opportunities, exciting us as we move forward in a host of industries where there's a tremendous runway, a lot of room to grow with digital acceleration. A couple of them jump out to me. The telehealth visits is an example. I'm sure there's not a person on this call that didn't have an opportunity or a family member have an opportunity to save a trip to the doctor last year. In fact, when you look at the example of what you can't even see the light blue line on the screen of what it was prior, but almost a 20,000% increase in telehealth visits last year. How about streaming? A wonderful example. Think Netflix. Gosh, Disney Plus couldn't have timed it better last year as they launched. I think 100 million subscribers already. But again, I don't want us to look at just the penetration rates of where they are, but the runway we think is incredible. And one of my favorites, and we'll look at this in a different context in a moment, is in the e-commerce. And clearly it's easy, and congrats to Jeff Bezos going to space yesterday. Amazon's a company that gets to play in a couple of these boxes because we think about how much e-commerce, and again, we're going to look at this in a different context in just a moment, but you think about the growth in e-commerce. It's not unusual I could give you a very real life example of my inability to buy something at a store in Cool Springs. They told me it was a 10-week delay of getting an item. I bought it from the same store online, and it's sitting here next to me. And that went from Sunday to today. So pretty quick, but big runway within e-commerce, whether it's Amazon, Target, we'll look at in a moment. But Amazon's going to show up again in cloud computing. And again, significant runway as you're seeing more digitization and digital penetration, the ability to host that in cloud computing, a tremendous runway. So a lot of excitement happening in that space. But let's look at some old industries for a moment, because this is really where, and I think Carl Kawaja, one of my coworkers, really says it best. It's, this theme of, does the empire really strike back, right? Left-hand side is vehicles sold. A great trend for us to keep our eye on, which we clearly know the story of Tesla, not only what's happening with the stock, but obviously the product is done quite well. But we're noticing General Motors is making a move into electric vehicles. Volkswagen's making a move in electric vehicles. Those are the U.S. companies. This is not just the standalone EVs. These are the U.S. companies that recognize the importance of penetrating that. General Motors sold 200,000 electric vehicles last year. What we're keeping a very clear eye on is General Motors and Volkswagen as two examples. In these disruptive industries, how do they respond? And we think a lot of them are going to respond well. They've got the infrastructure, they got the dealerships, they got a lot of going for them. They can get the technology and the battery piece right. You're going to see a tremendous opportunity there. So a lot of these disruptive industries, we're going to keep an eye on what happens to some of the more established companies, and can they find a way to play in the sandbox as well. And on the right-hand side, here's a good example. We just hit on it a moment ago, but the growth of e-commerce. Again, you take a Target, and to see significant growth last year. And again, the question is going to be, can they continue this growth? But to see Target grow their e-commerce sales as much as they have, or Costco, I don't know how you get your free samples on e-commerce at Costco, Home Depot. You're really seeing these I'll say, old line industries respond to this challenge. And that's going to be an interesting thing for us, from an investment view, to keep our eye on. And again, it's encouraging for us because there's a lot of great, well-managed old line companies that we have a lot of confidence and conviction in that we think are reformatting themselves into this new era. Let's talk chips. A couple more areas here of focus, and we'll get to the bond market and open it up for some questions. But chips, we call this a Chips Ahoy. And look, if I don't care what you're trying to buy right now, if it's delayed, it's probably because of the microchip, and the semiconductor space is really the home of this. And we are learning in real time right now, by the delays of everything that we can't get shipped to us right now, the importance, whether in the final product or within the manufacturing process, of the importance of semiconductors and chip technology. Highly investable asset class. It's not going anywhere. Left-handish side shows some of the biggest companies. And I will tell you, 20 years ago, there was probably 25 logic chip makers. You're getting down to a handful of dominant companies. Taiwan Semiconductor is a great example of that. Since 1987, it's a big company. They do big revenue. They're sort of like a foundry for chips, right? They're a contract foundry. So if I want a chip made, I can go to Taiwan Semiconductor and say, hey, will you make me a chip? They are opening, you may have heard the news, they're opening a facility in the United States in Arizona. So they're trying to solve some of their supply chain issues by moving and building out a facility here in the U.S. But keep your eye on these chip makers. Highly investable, significant runway. Again, right-hand side is a good example of where we continue to see growth opportunities for these chip makers. Again, highly investable. Some are better than others. It's our job to get in there and figure out what those are going to be. But I would propose that that's going to be a significant area of opportunity for investors as we move forward. Let's look at medicine for a moment. And I want you to think about this a little bit different. I don't want to make this, even though I'm going to give an example here in a moment of COVID. I want you to think about just the innovation and the acceleration of and advancements in medicine, going back to the polio or typhoid or measles, you pick it. What the previous timeline was to get this stuff sorted out, and you view that through this lens of what we did with COVID. And I'm going to show you an example of it because this may surprise a lot of you how that really happened behind the scenes. But for us to really solve for that, and I say us in a global sense, as quick as we did is rather remarkable. And I want to walk you through the timeline of this. And because I think this is important. And again, I want to be clear. As we're looking at this is not so much about an explanation of what happened with the COVID vaccine, but it's really allowing our investment professionals on a global scale to travel around the world. Right now, a lot of it's still virtually, to meet with healthcare companies to find what's that next great thing that we're going to solve for. And again, we are convinced that the playbook of COVID is going to make its way into many other healthcare opportunities. And again, it truly was a miracle what we went through. So let me walk you through it, because again, view this through the lens of not what we went through, which it is important, but what we think we can solve for, as we move forward. And January 5th, that was the day. That was when the genome was sequenced. And I think that's an important timeline as we start this, that it took them about 40 hours of working around the clock to sequence the genome. But what was important was what happened a week later when Professor Holmes, who's literally sitting on a plane at the Shanghai airport, and calls Zhang to say, hey, can we publish this? Like, we need to get to work on this. So within a week, he said yes, he agreed. And so they published the sequencing of this genome. And look what happened. Literally 2 days later, that the first vaccine process began. And that was with Moderna. A couple of days later, you start to see the one that Pfizer was working on. So really quickly, I'm talking 2 days from publishing this sequenced genome, technology and computer modeling take over, and they had the vaccine. And this is important because it may surprise you that a week later, 8 days later, here in the U.S., the first case is confirmed in Seattle. But what's buried in that story is about that same time, within that same time frame, within a day or two, literally, that the Moderna vaccine was being shipped to the National Institute of Health to begin phase 1 clinical trials. So before any of us had ever heard of this COVID-19, we were in the midst of a trial. And that's how fast medicine worked on this. And that for us is special. Now, fast forward to November. It took a while, again, in the grand scheme of a timeline, not that long, but from January to when they started to November, they started to show trial results. And then clearly by December, it was being made available for emergency use. And again, we're using this as an example to say what we see from a healthcare perspective on a global scale is special, highly investable. Many of you may be here in the Middle Tennessee area. I don't need to tell you many of you may be in the healthcare space. What's happening in healthcare and medicine right now is absolutely, it's a special time to see it. Highly investable, wonderful companies on a global scale that we're continuing to uncover every day on behalf of investors. And again, I think this timeline is a great example. And then finally, my sixth thing to consider as we're thinking about investment opportunities, I think we want to dust off this idea of dividends, and I'm going to give you a specific example, that make you think about it maybe in a different context. But we're seeing that dividends per share are continuing to climb, and for patient long-term investors, particularly, and this may be the key here, particularly those that may need an income stream off of their investments. We made it clear we don't see an environment where interest rates are going to be much higher for an extended period of time. So if I'm depending on my portfolio to spin off a little bit of income, dividends of stocks are going to be a wonderful, wonderful opportunity to consider in portfolios, or even just for more conservative investors who like the idea of sort of getting rent checks off of the stocks that they're holding. And you don't ride for free here. And if you're going to be in, a lot of investors say, hey, if I'm going to hold you as a portfolio, you got to pay me a little bit of rent as we go. What's interesting, and again, don't want to overemphasize it too much, but I do think it's important to acknowledge there are about 87 companies in the United States with a dividend yield greater than 3%. When you look outside the U.S., call it the international markets, 250. If I dig a little bit deeper into emerging markets, 365 companies. So I would propose that if we're considering dividend-paying stocks and we like the idea of dividends, a global view of that will probably make a lot of sense. So big outlook from an equity perspective, again, whether it's these value stocks making a comeback, some of these secular trends that we're noticing that are, again, highly investable, and these old line companies that are finding ways to compete in this new world, or that wonderful opportunities in semiconductors and the chip story, or even what's happening in medicine. A lot of that will be represented in the form of dividends. So again, I would say an optimistic outlook in a whole host of areas for us from an equity perspective. And let's wrap it up with a quick view of the fixed income markets. Won't spend a whole lot of time here. Happy to dig deep into it in Q&A, but I do think it's important to acknowledge, because many of us certainly have portions of our portfolios in fixed income. And I want to propose, as we kind of look at a couple of the highlights here, that bonds are in portfolios for a reason. So when we say fixed income, we're talking about bonds. And bonds are generally there for a reason. We've identified four. There may be others that you could point out, but we've really landed on sort of the four reasons I would own fixed income in a portfolio. And you can see them on your screen here. A lot of us will own them for diversification from equities, just risk mitigation. And I will propose that is alive and well and still working. Some may say, hey, I'm just owning it for capital preservation. I want to buy a house or pay taxes or buy a new car. I want to keep money in short-term investments. So we would say capital preservation is still a reasonable view. Inflation protection, a big story right now for those worried about inflation. We think fixed income, particularly TIPS, have a place in a portfolio to protect if there is inflation. And finally, income. And I think that's the one that's challenging us the most right now. And we'll take a look at that here in a moment, that with yields so low that we're having to extend to take maybe a little bit more risk than we're comfortable with. So of these four, I would propose income is more challenging, and we can go buy great dividend paying stocks that can probably match the income of bonds, but I get the chance at price appreciation, which is important. So let's talk, and again, a couple of big points here, and Jeff, you guys start gearing up for Q&A here. But I think a couple of big points that I want you to consider. Look, in March, I think the 10-year Treasury is close to 1.7%. And then we had a conversation internally where we see 2% before we see 1%. And many people at our firm were in the we'll see 1% camp. And we've now trailed down into 1.2, 1.3 range. So you're definitely seeing interest rates come down, which at some point we're going to make the argument, well, when do they go up? Well, as we know, when interest rates go up, your bond prices come down. So that's the risk in the bond market, is that rates are going up. And this historical view, I'm going to pick one just as the example, and just for simplicity, I'm going to pick the one on the far left-hand side. But 1993, my first year at American Funds, we saw the 10-year Treasury go up almost 3%. So that wouldn't have been good for the fixed income portion of a portfolio. But, and this is the key, had I held, and we're using the Barclays U.S. Aggregate Index as our example, if I just held my bonds for 2 years, right, ignoring the volatility in that rising rate environment, and held it 1 year longer for argument's sake, so a 2-year time frame, my loss turned into almost a 10.5% gain. So I will propose, if you have fixed income in a portfolio and its sole job is to protect you against, for diversification purposes, and rates do start to move up, hang in there an extra year, because history has shown a 2-year view has worked quite well. And then we'll wrap it up with this. I mentioned it earlier, like if you need income from portfolios, equities would probably be the preferred way to go. As I look on, to get, higher yielding fixed income right now, you're going to have to take risk. It's not going to be in the corporate space. It's going to be in these high yields, or it's going to be in emerging market bonds. Think Mexico and Russia. Probably not as ideal of an investment landscape for you, but if you need income and you want to own fixed income, you're going to have to diversify in the more risky asset classes. And again, I would propose equity service quite well. But the silver lining, the good news, so to speak, in the bond market is we're a big fan of the municipal bond market right now. And for those of you that have, non-qualified assets, you may have sold a business, or you've got some assets that aren't protected by an IRA from a tax perspective. It's a pretty good time for municipal bonds right now. And a big chunk of that has been because of a lot of the stimulus that's happened. Let's do the rescue plan here that we passed in March. And almost $600 of the $650 billion went to state and local governments. That's very supportive of these municipalities' ability to make their interest payments, which is the risk in the municipal bonds, they're not paying their coupon. So big fans of the muni market right now, particularly with a lot of the stimulus that's impacted them. And the easy way to think about it, let's just say that you're in, the highest tax bracket right now. So for a married couple, and I know that's a lot of money, but we'll pick it as our example. If you're a joint household making more than $628,000, a lot of money, but we'll use that as our example here. From a yield perspective, the pre-tax nature of munis right now on high quality munis, 1% yield would mean you're really your pre-tax, your after-tax yield is 1.8%. But when you look in that high yield space, which we're a big fan of, your 3.4% pre-tax yield is looking a lot like that 5.8%. Again, let's go back to what we're seeing in emerging markets. I would much rather, if I can, own a high yield issue here in the state of Tennessee versus a Mexican government bond right now, because we can research the credit. If you're in the 32% tax bracket, still a very compelling place to be. So I think a lot of these munis make a lot of sense. So Jeff, let me just summarize that. Look, we talked about it, value or growth. Look, from an equity perspective, I think own them all. And lots of funds we can talk about, and global international outlook continues to be strong as we see Taiwan Semiconductor and some of these healthcare names. And again, we just hit taxable and tax free. So let me stop sharing there, Jeff. Turn it back to you and Drew, and let's take this in any direction you like. You're muted, Jeff. Sorry to be the guy that has to point that out.
Yep, we got some great questions, Chris. Thank you. So if you have questions. Bottom middle there, you should have a Q&A if you can type in, but we'll have Drew. We've got a couple questions beforehand, and then we got a couple sitting here. So Drew, if you'll hit those, and Chris will allow you to provide some insight.
Yeah, absolutely. Chris, sure. Thank you again. Got some questions moving in here, and keep asking them. So a couple questions we got even before the call here. This first one is really a cash management question. I'm looking at cash, it's making zero. inflation, although maybe not going to be as big as the fear was a few weeks ago, is still outpacing, or inflation is outpacing cash rates. So where does somebody go from a cash management situation, just trying to have their cash keep up with purchasing power?
Yeah, right. I wish I had a silver bullet for that one. Boy, if we could find that one, Drew, right, we would solve a lot of investors' problems. So two thoughts. And you know, my first, when we consider cash, I think there's two ways to think about it. Number one, and again, if we're a big group of people and I could see everybody, I would say, hey, raise your hand if you carry a spare tire in your trunk, and every hand will go up. And then I generally would follow that with how many of you carry more than one? No hand goes up. And I think that's important as we think about cash, which is why do we hold it? If we're holding it for a spare tire, let's hold that in cash, right? A zero return is reasonable because we're holding that for an emergency, a spare tire. It's okay. Where we get into trouble is when we have 3 or 4 spare tires in our trunk and we're holding more cash than we need. And it really comes down to those extra spare tires. Well, what's the objective of those, right? If the long game is to put them into a risk asset, meaning we're waiting to put them to work somewhere, maybe we can accept a little bit of fluctuation. And again, short-term municipal bonds make a lot of sense for that. Again, hard to argue that we have cash in an IRA account that's short-term because you're going to need it at retirement. So I think that one's a little bit different. But if you have non-qualified assets that are taxable, I think short-term munis will continue to provide a reasonably good place to be. But again, keep that spare tire in mind, because a lot of people are just carrying cash and maybe just a little bit too much of it.
Yeah, while we're on the topic of cash, one of the questions that came in live was how many years of expenses do you recommend a retired person keep in bonds and cash?
Well, I'll let you guys take that one. What's your go? I mean, my idea, but who cares what I think? This is your world here.
You know, I would say it depends on, you know, the total size of the portfolio and the cash needs relative to that. And so, you know, for some retirees, we've got to kind of have the whole thing invested and working to outpace inflation. For other retirees, you know, maybe the plan allows for what we typically talk about is maybe a couple years worth of expenses in cash. And the reason for that is it just provides that additional downside protection. If we're taking money out of investment accounts, and we hit a period like we hit last year, although it was short, but we have a large drop in the market, but we can stop taking money from investments and maybe take it from this cash that obviously did its job. It didn't drop it. And typically with a pretty moderate portfolio, historical drops, you're back within a couple years. That's where that 2-year number comes from. So Jeff, I don't know if you have anything to add to that, but that would be the initial thought there.
Yeah, you know, I think it would encourage people to do what feels most comfortable. Most people on this call can afford to be more conservative than they were when they were growing up. You know, most of the folks on this call are retired, and they would have been crazy if they ever thought they had $100,000 or $500,000 or $1 million of cash, because they didn't have that net worth when they were working and building their family legacy. And so now, though, that they have that cash, they're in a different paradigm where they can afford to be a little bit more conservative, or a lot more conservative. And so there's no question that having that cash makes these impacts. You know, last year, with as tough as it was, 38% pullback in the market, world came to a screeching halt. It sure was nice for people to have cash because, one, it provided a lot of safety, a lot of comfort, but it also totally reduced the likelihood of losing any money, because actually they could spend out of that cash, the market comes back, they turn the income back on from their cash. They literally were irrelevant to the fact that the market dropped. It had zero impact on clients' real net worth. It was all just psychological and allowed them to weather that storm. So we've always been big proponents of cash. Cash is king has been something that we've talked about for 20 years. And so we found that helps people be better investors if they have more cash, because then they're not stressed out and they can allow those monies to be a little bit more volatile in the equities, which over time have done significantly better. So it's a case-by-case basis, but I wouldn't let anybody discourage you from having whatever cash limit it is that you feel comfortable with.
Good, Chris. We've had a couple questions about this Delta variant that's happening, and so you know, if this were to happen, it's almost kind of round 2. Okay, we learned a lot from round 1. Governments across the world get a second chance of reacting to it. So there's a question just about how do we think governments would respond if this really had some legs on it. But then 2, you know, knowing what we learned from the market reaction and the economic reaction that happened with the first one, how does an investor prepare for that?
Yeah, great question. It's an important topic. So the Delta variant. So Ashish Jha, who runs the, I guess he was at Harvard, now he's at Brown. He was in the office with our investment folks last week, specifically on this question. So we're not looking at it nearly through a company lens, but through a macro lens of exactly that. And I think the view is, and this may not be a popular view, but the view that his view, Ashish Jha, if you haven't read any of his stuff, he's the dean at Brown University. The A view, I don't want to make this specific to him, but the view is it may be a little bit worse than people think it is. And you heard the term this week, it's this pandemic of the unvaccinated. And I think it's all going to come down. You're seeing far more politicians and others come out that we got to keep pressing this vaccine story. And that's the view of how that one will be controlled. Again, the research isn't quite clear of the impact that's going to have on the vaccinated. It doesn't look like it's deadly by any stretch. So I say all that to say this: I'm not hearing from any of our folks, around the world right now that that if that does continue to creep up, and we think it will, that it's going to have the shutdown capability, right? We now have a vaccine. We sort of had the keys to the kingdom here. When we shut this thing down in March last year, we didn't know what we were dealing with. We know what we're dealing with now. We know how to solve for it. So I think it's going to be interesting to see how that one plays out. But again, I think if you're vaccinated, and again, the numbers continue to get better, not quite where they need to be probably, but from an economic perspective, not a political reference there, but just from an economic perspective, I think that's what we have to keep our eye on. But I don't sense that, again, there's $15.7 trillion today in negative yields. The Fed can't go below zero now. So, I don't think they signal their intention to go below zero. So I don't know that we have any more bullets left in the gun, pardon the analogy, here in the U.S. from a central bank perspective, which is why I think we're going to keep rates low. So keep an eye on it. From an economic perspective, if everybody gets vaccinated, this will probably be far less of an issue, and we just have to keep our eye on that one. But we're not hearing any sense of, certainly, no shutdowns or any of that. I'm not hearing any sense of that.
Okay, great. We got it. There's a couple other inflation-related questions, but I'm going to hop over to. We had one come in about potential tax increases and how that hit the market and historically how it's hit the market. So if you could talk on that a little bit.
Yeah, it's funny. I'll send you this, Drew. I got it yesterday, so I'll send it to you. Our private client group, which and Jeff know. They put out a report this week that showed stock market returns in years where there were corporate tax increases, personal tax increases, and capital gains tax increases. And I don't want to bury the lead on this one at all. 75–80% of the time, markets are positive in years in which there is a tax increase, and they're generally up pretty good, right? If stocks have averaged 12.5% since 1930 or so, I think the worst average return is for years in which there's a personal income tax increase. Under that scenario, stocks only average 8.5%. And I think 75–80% of the time positive. So I wouldn't spend a whole lot of time worrying about the stock market's reaction. There's no evidence historically, again, maybe a year here, maybe a year there, but I wouldn't spend a whole lot of time worrying about the stock market's view of potential tax increases. That doesn't diminish the individual impact that potential tax changes will have on us. I don't care who you are in this call. I don't want to, we don't have to speculate on the merits of tax increases and what's going to happen, because it's all going to get negotiated, and you got midterms coming. It's a political, hot topic right now. I get it. However, let's just cut to the chase. The estate tax is due to sunset in 2025. So if right now you have $11.7 million of exemption, I can die this year and use my 11.7, or I can gift it to an entity that I have full control over and remove 11.7 million from my individual estate. I don't see that ever getting better than it is now. So whether they change it this year or they change it next year, I would say now is a wonderful time to make sure we have an estate plan in place. We don't think from a political view right now that there's going to be a whole lot of appetite for tax changes prior to the midterm. So we wouldn't anticipate significant tax changes related to some of the bills that are getting through. Biden clearly wants to get this thing done in a bipartisan way. He doesn't want to force it through reconciliation. He may have to, but the evidence to us, at least behind the scenes, is he wants to be seen as this reconciler. Pardon the exact, the term reconcile there, but he wants to be viewed as the guy that can bring the parties together, this great negotiator, and he's not going to be able to do that with tax changes. So unless it comes through reconciliation and they force some things through, we don't think there's massive anticipation. And again, market is indifferent to that topic anyway, or at least history has shown the market has no impact on it.
Okay. We had a question come in about gold, and really the question is, when the pandemic started, it experienced a pretty sizable increase. Typically, their increase is when they're inflation scares, and so a few weeks ago, when we initially had that, we've not really had this huge spike that you would think in terms of the price of gold, silver, precious metals. So the question is, why is that not going up, the price of gold, when there is this fear of inflation? And maybe the question that I'll add to it, which could be behind the question, is gold and precious metals, are they great investments just in general and in inflation environments?
Yeah, well, let me tackle that second part first. I think the greatest investment advice I've ever heard in my career on those questions is the answer is some. I think some of anything is probably a good idea, right? It's just sizing in the portfolio what makes sense. There's a lot of people that made a lot of money on gold and commodities and silver and oil, and I give you a list of these things that American Funds and Capital Group don't manage. That doesn't mean that they're bad ideas. So I think every individual circumstance is a bit different. Now we have to, and I don't want to open Pandora's box of this one, but now you have to throw cryptocurrencies in that conversation as well, right? Should I own Bitcoin? So my answer to everybody, some, right? Yeah, it's okay to own anything. Now, specifically with gold and the inflation comment, it's interesting because there are very clear examples. Mid-70s, mid-late 70s is a great example of where gold was up big, inflation was big. But I can also point to a few other instances where inflation was high and gold didn't track it, right? So I don't know that it's historically as correlated as we think there are, even though there are clear examples of where it is. I think there's a couple of things happening with gold right now. One is supply and demand. I think a lot of the folks that tend to like those commodities, maybe putting them into other risky assets, and I say risky, it just means stocks, things that have a different risk profile. So I think it's a little bit of a supply and demand game. Maybe they're buying cryptocurrencies, maybe they're putting money to work in some of these other alternative strategies. So I think a little bit of that's happened, but I think the other side of it is that you're hard pressed to find a lot of investment professionals that are in the inflation camp right now. Again, you will find some, but it's really hard to find someone that's going to pound the table on a tremendous amount of inflation. And I think that's why it's the fear of inflation. I mean, I'll give you the bet. I had to look at it this morning, so somebody maybe look at it and fact check me on this one. But I think yesterday the 10-year break even on inflation. So if you go to the Federal Reserve's website, fred.org, I think it is, you put in 10-year break-even inflation, I think it'll come right up. I guess it was maybe 2.23, 2.25, somewhere in that range, which is the Fed's target for inflation, right? So the bond market doesn't think that there's inflation. So I think that's impacting gold, is that it's more headline risk of inflation and not the reality of inflation. So if there was real inflation, I think the break-evens would be higher, and I think gold would be higher. And I think neither one of them are, because I don't think professional investors are really thinking there's going to be significant inflation. Doesn't mean there won't be inflation. I don't hear that, but we don't think there's going to be significant inflation.
Okay.
I say that as I'm trying to buy a used car for my son, my wife. It's just went to Costco, and the receipt was a mile away. There's inflation. I get it. I bought Traeger pellets yesterday. You got Traeger at Home Depot in Franklin, and I was livid. The price was the same, but the package was smaller. That's inflation. I couldn't believe. I fit 4 of them in my car. I'm like, where did these things go? So the price didn't change, but the package got smaller. So there is clear signs of inflation. So I don't want to dismiss inflation too much.
All right. Well, this is a question we've been getting for years because it's not gotten any better, but it's the federal debt question. We have this huge debt. It gets larger by the year. Feels like we're just kicking the can down the road with this thing. When does it, or will it eventually impact investor portfolios?
Yeah, sure. It's a scary thing. I mean, I don't, and please, my smiling is not dismissive. It's me every year, like for 20 years, we've had to answer this question to some degree. So let's tackle it. And again, I don't know how this thing's going to play out, but I will say this, well, I'll say this, and this is true. The numbers are tiny, but there is a voluntary system to help retire the federal debt. So you can make voluntary payments. And I'm curious if people that receive these child credit checks, $300 a month, that are anti-government are going to send those to the Treasury to help retire the debt. I don't think they are. They're going to spin it like I would, but so, you know, that observation aside, look, it's real. And I think the playbook for the government is, you know, if we can grow our way through this without inflation, then, you know, growing tax rolls will take care of this over time. And that's the play that they're trying to run right now. And maybe a modest increase in taxes will help it, but keeping rates low and stimulating growth is the strategy that the governments chose. And, you know, the last time we had debt to GDP, government debt to GDP at this level was Second World War. And the way out of that one, by the way, which they got out of it, was inflation. It was out of control inflation. So they're trying to balance this thing right now. So I think it'll be a growth strategy, and at some point, we're going to dust off the word austerity, and government spending is going to have to get under control. With that will be a little bit of an increase in taxes, or maybe a lot of bit of an increase in taxes, depending on the political climate. But that's the thinking. And I smile only that, you know, everybody says this. And I remember, you know, hearing, my grandparents' generation, well, our grandkids are going to have to deal with it. Well, now I don't have grandchildren, but now my grandkids are, you know, we all have younger children. Like we're pushing this off to the next generation, which the last generation pushed it off to us. So maybe we do keep kicking the can, but watch for growth. If we can grow in those numbers we showed earlier, that's going to help tax rolls. Modest increase in taxes may help kind of get this thing under control over time. If not, we'll just keep kicking the can down the street.
All right. We've got one more time for one more question we'll hit, and then Jeff will close us out here. But last one, it continue with this inflation theme. It hits the labor market. 3 jobs open for every unemployed person. Seems like there's a kind of a higher wage demand that's happening right now. What are Capital Group's thoughts on how just the general trends of the labor market are going to impact inflation?
Yeah, and that's the one. I mean, that's a wonderful question, because that really gets it. And generally, I hit this in the comments. So I apologize for not even making a reference to it, but we will see real inflation when we see wage inflation. And candidly, with everything that's going on, you think you would be seeing wage inflation. I mean, what companies are having to charge right now is at a higher level or pay, but they're still not getting employees. And I think you're seeing this, at least what we see, is this convergence of increased technology is allowing maybe for fewer workers to work in some of these jobs. And so I think it's a little bit of a subtle shift in a demographic shift of what's happening. And again, you would think at this point in the cycle, we would start seeing significant signs of wage inflation, which again, I would argue will lead to price inflation, core price inflation. Just not seeing it yet. So that's the one that's probably the most confusing for us to really get our arms around right now, is, you know, the impact that the labor market, what's that really going to look like? You know, I've got kids in college, and, you know, I'm like, what do I study? I'm like, I don't know. Like, go work with Jeff Dobines and Drew McMillan in Southwestern, because there's always going to be a need for great advice. But beyond that, I'm not sure what industries what industries are going to look like going forward. So great question. Wish I had a better answer, but watch wage inflation. Just not seeing it. We think we would, just not seeing it yet significantly.
Well, we'll wrap up so we close here before the hour. So thankful for everybody's participation and sticking through there on a beautiful day here in sunny Nashville after a tumultuous couple days this past week in the market, but a real benefit to get together and talk through what the forecast looks like. So Chris, Jenkins, thank you. Everyone, thank you. If you have any questions or comments or need help, please reach out to your advisors or anybody on our team. We'd be happy to help guide you in the right direction. So grateful for everybody. Let us know if we can help. Thanks, Chris.
Thanks, Jeff. Thanks, Drew. Thanks, Kelly, behind the scenes, making it happen.